virtual Lunch and Learn seminar. Today's topic is Finding Your Client's Inner Philanthropist. How can professional advisors pop the question of charitable giving? I am Pragya Murphy, Development Officer at the Central New York Community Foundation, and I'll be moderating this panel today. We have an expert panel lined up here to share their practical and personal insight, and I'll introduce them in just a couple of minutes. Just wanted to go through some of the housekeeping items. Please show your name and your firm on the screen. We'll have everyone on mute besides the panelists and myself. Please feel free to type in your questions for our panelists in the chat box throughout the seminar, and we will try to have a Q&A session toward the end of the seminar. Just to let you know that we are recording this, and I see Dara, you have the recording already, so great, thank you. 1 hour of CFP credit is being provided by the Financial Planning Association of Central New York. Those of you who are seeking the credit will need to fill out the online CE form that was provided in the reminder email. Dara, thank you. You read my mind. So, and please note that there are 2 mandatory, verification codes required for the CFP, and that will be provided randomly through Zoom polls. So let's get started. Just to give you some background, as a community foundation, we work with donors to help them support the causes and the charities that are close to their heart. We manage over 700 funds set up by individuals, businesses, and nonprofits. The funds set up by individuals provide the support for the greatest needs of our community during their lifetime and or through their legacy gifts after they're gone. The key to connecting these donors is professional advisors in our community, and most of you here. While we work with many advisors, we have been working with them over the years, we know that there's always more we can do to raise awareness of the options and the flexibility of charitable giving through the community foundation. And again, you professional advisors are key. We've been seeing that more advisors and clients are talking about charitable planning. The 2017 Tax Cuts and Jobs Act, the concept of bunching donations, the popularity of donor advised funds, the generosity of clients and growth of their investments, the continued needs of nonprofit organizations, and the understanding that the advisors can have more of an impact are just some of the reasons why these conversations are important and are increasingly taking place. That is why we have these 3 highly experienced panelists from different aspects of planning areas here today to talk about their approach with their clients about charitable giving, how they listen, and then how they identify charitable giving opportunities to benefit their clients in a variety of ways. So I'll go ahead with the introduction alphabetically. First, we have Karin Sloan DeLaney. She's an estate planning attorney at Sloan DeLaney PC. She has over 25 years of experience in trust and estate law, elder law, special needs planning, and tax law. Karin currently serves on our board of the compliance as the compliance officer and has helped many of her clients open charitable funds at the Community Foundation as part of her estate planning work. Karin is a member of the State Planning Council of Central New York, the New York State Bar Association, and the Baldwinsville and Liverpool Chambers of Commerce. She has served on several nonprofit boards and currently enjoys being a volunteer at Sunshine Horse Rescue. Welcome, Karin.
Thank
you. So next we have Grace Ghezzi. A lot of you know Grace. She's the owner and financial planner at Grace B. Ghezzi Consulting, serving clients in Syracuse and surrounding communities. Grace has worked in the tax and financial planning areas for over 40 years, and she was also an adjunct professor of federal income tax accounting at Lemoyne College. Grace is licensed as a certified public accountant in the states of New York and Florida, holds designation as certified financial planner, and also an accredited estate planner. Grace has also served on our board as the chair of the development committee, and she's also a member of the Lemoyne College Accounting Advisory Board. Thank you, Grace, for joining us today.
Ragia, thanks for having me. It seems like my Zoom video has gone out. I apologize, but I'm still here with you.
Okay, great. If you, try to put the camera on. If not, that's okay. We'll just go along. Next, we have Madelyn Hornstein. She's CPA and CEO at Dermody, Burke and Brown. I'm sure most of you know her. Madelyn serves small business clients as well as high net worth individuals with their accounting, retirement planning, and tax needs. Madelyn is a former member of the board, the Community Foundation Board. She served as the chair of the Finance Committee, and she continues to serve on our Professional Advisor Council. Madelyn is also a fund holder at the Community Foundation, and Madelyn is also engaged at other nonprofits such as the Center State CEO and the Wise Women's Business Center. So thank you so much all, and I don't see Grace, so maybe she's trying to join us back.
I am back in.
Okay, perfect. All right, thank you all again. And just to get the discussion started, I'm going to pose the first question. And Karin, you are first. So the first question is about, just how you approach the first question of charitable giving. Why do you think, as an advisor in your respective or your estate planning work, it's important to bring up the topic of charitable giving? And how do you go about that conversation of charitable giving with your clients? And when you do so, what type of questions or ideas about charitable giving do you find resonate most with your clients?
Thank you, Pragya. I think to begin, I liked a word that you used in your introduction when you were introducing all of us as the panel. You used the word listen. So I think that's a big part of the conversation of charitable giving. And I use the initial meeting that I have with clients to discuss their planning to really, that's my listen and learn. So that's my opportunity to maybe take a step down from the real technical issues, but to find out more about my clients as people and what their worries are and what their passions are and what brings them to my office or to my computer screen these days. So that's my time to listen and to learn. I think it's also time that you build up a relationship and trust with clients, and the better relationship and trust that you have with your clients, the more they tell you about themselves. And that just, from that conversation, I think the topic of charitable giving just naturally evolves from it. I learn about what makes, what they like to do in their spare time and what causes they may feel passionate about. Sometimes people come into the office and they have heard from their neighbors that they need a trust, or they need this, or they need that. And sometimes when we take a step back and we listen, we learn a lot. And that's where the topic of charitable giving, I think, really evolves. So that's how I approach the initial conversation and bringing up the question.
Great, thank you for sharing your insight on that. Grace, I'll ask the same question to you, and we can still hear you, so I think it's good.
Wonderful. It's interesting when people come to me for planning. We need to look at things in a very comprehensive manner. And planning has so many different variables, anything from a full plan to just looking at insurances or investments or tax planning or estate planning. Often it's to look at retirement cash flow planning. So people come to me basically to make sure they haven't forgotten anything, you know, to see if there's better ways to accomplish the financial goals they have. Also to determine if their goals are realistic. So I need to get inside their heads financially. I really need to determine why they're coming to me. You know, planning's a little bit different than tax and estate planning because at least you have a general framework as to what people want to accomplish. So with financial planning, it could be a lot, it could be just a little. The big key for me is to make sure that people's wishes are met and to gain their trust, to get them to talk about all of these topics that are so important to them. Now you may be thinking, what does this have to do with charitable giving? Well, before raising any financial planning topics, I ask people two questions. My first question is always, please tell me why you're here. That may sound kind of obvious, but because it's so broad and because husbands and wives or partners in a couple often think differently about planning. Maybe they have different relationships with money, different knowledge base. Maybe as children, they either had money or they struggled because they had debt. So that impacts how people feel about planning. So as Karin mentioned, listening, I feel the same way. It's really important at the beginning stages for me to really listen to what people are trying to accomplish. So that's always my first question. Tell me why you're here. And it's important I hear from both spouses because again, their answers are usually different and they don't know that coming in, but that's typically, you know, they're in a different place. My second question is always, why are you here today? What brought you here today? Coming from a CPA world where we had deadlines, financial planning has no deadline. What prompted you to get here now? And I find that there are usually financial events that occur in people's lives. And there are four main financial events that I think people come to me because of. The first one is retirement. You know, that may be imminent. It might be around the corner. It might be 5 years from now. It might be 20 years from now, but people are planning to make sure they have enough money. The second event is death. Has someone recently passed away? Has their estate been a mess? Has the family been in discord? You know, what issues occurred? I had a client tell me last week that one of her family members passed away and there was no life insurance. And so she flew out of town to help the family. So death brings out planning needs for people. The third one is an income tax event. So are the rates going up? Are you anticipating a taxable transaction? Those are reasons why people want to do planning, figure out if they can mitigate that. And the fourth thing is the financial markets. Are you worried about risk? Are they up? Are they down? Are you worried about running out of money? So those are really the reasons that people typically come to me. They don't always know the reasons until we start talking about it. So until I find out why they're coming, and they'll rarely say charity is a goal at that point. I still haven't brought up charity yet because I need to figure out what they want and educate them about what options are available to them. I find that when it comes to charity, people don't realize it's part of financial planning, and that's typically why they don't mention it. Charitable giving to most people is writing a check or donating clothing. I mean, they just don't, I mean, it's like paying their utility bill. You know, they get their church envelope or whatever they use to prompt them to give to organizations that are maybe something in the mail, and they write the checks. And they typically don't think of charities being part of financial planning. So I use a questionnaire. I look at tax returns. I look at estate planning documents to try to identify charitable intent. And at that point, if it hasn't come up, I raise charity. We talk about how it fits into their plan. I find that people are very receptive once we talk about the different strategies available to them, what assets they have, what their structure is, and what the timing is. So that's kind of how I bring up charity when I meet with clients.
Thank you, Grace. Madeline, same questions. How you bring up the topic of charitable giving with your clients in your tax planning work?
Oh, it's funny. I could talk for hours as to all the different paths that we go down with our various clients. Some are real basic conversations, and some get more complex. But I actually think as CPAs, we have it a little easier than the financial planners and the attorneys because they have to meet with us at least once a year, to get that dreaded tax return done. And also in preparing their income tax returns, we know who's charitable and who isn't. We get all of their information as to where they're donating. We know what people's required minimum distributions are coming out of their retirement plans, when they just inherited a bunch of money or they're in line to inherit a bunch of money. So I actually think it's a lot easier to broach the subject of charitable giving because first and foremost, we see them probably more frequently than the attorneys do. And there's not enough graces out there because a lot of times in my experience, a lot of the brokers, they talk about the investments and they don't delve down into a lot of the things that Grace just mentioned. We know if they have more money than they know what to do with. So if we run across those types of people, it's very easy to know which path we need to go down. We have had to tell people, sorry, you can't retire because you'll run out of money, too soon and those sorts of things. So again, like I said, I think I have it easier than most people. And I guess just the teaching aspect, I think that part of being a CPA is to know all the tricks of the trade, know how to use the tax laws to your advantage and how you can add value to that client relationship. Well, if you do this, you'll benefit here. If you do that, you'll benefit there. So I just think that the teaching is important. As far as, younger people meeting with clients, I think it's important I'm more experienced than some, but I think it's important for our younger professional advisors to understand that they don't need to have all the answers to ask the questions. They just need to know where to find the answers. So I think it's important to give them some of those talking points and some of those questions to ask their clients so that they can start to develop that stronger relationship. So it's not just getting a tax return out the door. And some people find it easier than others, to ask those questions when they might not know all the answers. But I think it's amazing the number, some things that we as professional advisors think are so basic that people don't know the answers to. I mean, how many times, and I can tell the people on the call and how experienced they are, but how many times do you run across people that think that if they gift more than $15,000 to somebody, that they have to pay the tax on that they actually have to cough up some money, or people that think that if they inherit money, it's going to be taxable to them. I mean, just some real basic things that we can cover with our clients. And again, those that are in a position to donate, we're right down that path and we're telling them how to do it as efficiently as possible. I think it's easy.
Yeah, thank you all for your insight. And, Karin, you bringing up just listening to your clients, and just asking them, some questions to prompt them to think about, charitable giving. And Madelyn, for you, you say it is easy, but, just making sure you're looking through their tax returns and looking at signs. So that, yeah, thank you. That's so important. And, your comprehensive approach to, planning from various aspects. So thank you so much. So many professional advisors that we worked with have asked in advance, if you could share a real life example So they might be able to relate to their own scenarios with their clients and apply those techniques. So I'll ask the next question, and Grace, you can go first. And I'm gonna reference the Popping the Question series that Grace had done in March. Grace, you had said that you often suggest your clients engage in charitable giving as a way to better reach their goals, not necessarily increasing their giving, but simply timing in a different manner. And you often suggest charitable giving strategies such as a donor advised fund, making gifts of appreciated securities instead of cash, or creating a charitable remainder trust, CRT, to enhance their retirement income. Can you please elaborate on that a little bit and walk us through a scenario you might have had with a client, and when you've done that, and if that client pursued it, what type of charitable giving vehicle he or she utilized with the community foundation, and what type of impact it had on your client and yourself as an advisor?
Sure, I'd love to, Pragya. Thank you. Regarding what I had written about those taxable events, it's very common when someone has something that increases their taxes in a particular year, such as a Roth conversion. You know, we're finding those pretty popular. Tax rates might be increasing, so people are looking at that as an alternative to pay less overall tax. So what do we do to offset the tax? Perhaps a donor advised fund, which doesn't necessarily change the amount that people give throughout their lifetime. It simply funds that now, so they get the write-off now. A very common strategy also is for people that are retiring and have net unrealized appreciation of employer securities in their 401k. It is the only way I know of to get capital gain treatment out of a retirement account. But when you do that, you're creating typically a very large ordinary income consequence in that year. Again, perhaps a donor advised fund or some way to offset that with charity might not necessarily change the total of your giving, but change the timing. What I plan to talk about in my example is a charitable remainder trust. I have found them to be very appropriate in certain circumstances, so it's got to be the right thing for the client. Now, just to back up a bit, a charitable remainder trust, you typically fund with appreciated assets because when they get put into the trust, there's no tax on the gain when those assets are sold. In addition, the client gets a charitable deduction equal to the actuarial net present value of what the charity gets at the end. So there's some pretty good upfront benefits there. Now, it's irrevocable. Clients can't get their principal back, but they get income for a period of up to 20 years or for their life or lives. So some pretty good benefits there. The income interest can be from 5 to 50%. Of course, we try to keep that on the lower end, so the trust actually accomplishes something over a long period of time. A very important strategy that I'm seeing an increase in right now due to some tax law changes are using a charitable remainder trust as beneficiary of an IRA. That keeps the IRA tax-free, and it also allows the stretch that we no longer get from many beneficiaries because of the new 10-year rule. So charitable trusts, I think, seem to be pretty applicable. Now, to set up a charitable trust, of course, you need a number of professionals. You need an attorney to draft the trust. You need a trustee to manage the assets. You need a CPA to do the tax return, the Form 5227. You also need an investment advisor to invest the money. A way to streamline all that, you certainly want to involve your professionals, but not to sound self-serving regarding the Central New York Community Foundation, but they can serve all these roles. They can be the trustee, they can invest the money, they can get the tax return done, they can set up the charitable trust. So I have also found that clients love to streamline and save money, and certainly using the Community Foundation can do that. And I must disclose I'm a board member, as you all know, just to make sure there's no conflict of interest. Now, to go through my example, I actually put together a sheet that I'm going to ask Dara to please put up because there's lots of numbers and it's easier to explain if you've got something to look at. This is an actual client of mine. This client came to me in the summer of 2005, and he was 59 years old. And now it's 15 years later. He came to me because he was selling land, and the land sales price, the fair market value, was $833,000. And his cost basis was $155,000. So he had a big gain, $678,000. The question he asked me, which I think he was joking, he said, "Is there any way I can do this without paying tax?" And my answer was yes. And he looked at me like I had two heads, and I told him about charitable remainder trust. Well, to make a long story short, following summer, after giving this enough time to be a viable transaction, we created a charitable remainder unit trust. He took back 10%. Now, this is the highest I've ever seen with my clients, but he wanted the money, his money. The more you take, the less your charitable deduction and the less that goes to charity at the end. But nevertheless, he chose charitable remainder trust, and we're now 15 years into it. So the reason I picked this example is I have a long history here. And these are actual numbers from this example. With the charitable trust, he got $833,000 and it went into the charitable trust. It has earned $342,000 in the past 15 years. It's been an average of 6%, but because of the ups and downs, of course, there's variations there. Over the past 15 years, he has gotten $769,000. And the expenses we incurred were about $90,000. Today, the end of April, the value of that charitable trust is $316,000. So what have we done here? What have we accomplished? Well, he's gotten $769,000. Those were checks written to him. He got an initial tax benefit. His federal and state tax rates back then were 28%. His $678,000 gain saved him $190,000. His charitable deduction was $161,000, and that deduction can be taken and carried forward for up to 5 years. So his benefit was $45,000. So in actual dollars in his pocket, he received $1,004,000. Well, what if he didn't do the charitable trust? Where would we be today? So I took the proceeds from the sale of the land and I subtracted the tax. We're down to $643,000. If he invested it the exact same way, he would have earned $264,000 on the $643,000. He received $769,000. So today that account balance would be $138,000. He would have gotten his $769,000 and he would still have the $138,000. So he'd have a benefit right now of $907,000. He's better off, even though he didn't have the principal, he's better off to the tune of $97,000. He has just turned 75. He's alive and well. Hopefully he will continue to benefit from this charitable trust for many years, but he has already gotten beyond the break-even point where having the charitable trust has given him more in his pocket than if he hadn't done the trust. Now, in his eyes, he was planning to just put the money in the bank if he didn't do the charitable trust. Well, the end of this example says, well, if we didn't do the trust and he earned 3%, he would have gotten the $643,000 after tax. He would have earned $174,000. He would have gotten his $769,000, and there'd only be $48,000 left in that charitable trust account if it wasn't a charitable trust and was sitting in the bank. So what would he have received? He would have gotten his $769,000. He would have gotten the balance, the $48,000, but in a year, the principal in that account would be zero. So if he had put it in the bank next year, if he had taken the same distributions over the last 15 years, he'd be out of money. And if he didn't do the charitable trust, he would continue to get less benefit. With the charitable trust, assuming he lives a number of more years, he will actually have a much higher benefit from doing the trust than if he didn't do it to begin with. So that's my example on how sometimes these things can not only be best for the charity, but best for the client and actually enhance your income. You know, some people take out life insurance if they do this, so their beneficiaries don't end up without the money. So you really need to run these numbers and grab your professionals and put them all in a room and have them work together to see if this makes sense for your individual client.
Thank you, Grace, for going through that example with us. You know, some of our donors do have CRTs at the community foundation, you know, so benefiting the charity, but also receiving some income during their lifetime. So perfect example. Thank you, Grace. Madelyn, I'll ask you to run through, you know, go walk us through a scenario that you've had with your client from your tax planning work.
Okay. You know, certainly the obvious ones are the clients that set up the donor advised funds when they're selling their businesses. And I've had situations where, you know, we've talked people out of creating a private foundation because it's so easy to just let the community foundation deal with that. So I thought I would take a different approach and talk about a situation that didn't go the way we had thought and what I learned from that and what I would have changed today had I known that. And it has to do with retirement plan, because one of the questions that I always ask clients, no matter what the age is I make sure that they're keeping the beneficiaries of their retirement accounts up to date. Because as you know, that's very important, and the retirement monies pass outside of the will. So the scenario I have is I have a client that had a very, very large IRA and was also very charitably inclined, was afraid that, you know, she didn't want to run out of money. So she was hesitant to give it away too early. So what we did was we named the children and the grandchildren at varying percentages as beneficiaries of the IRA. But we also named the two churches, you know, the one up here in Syracuse and the one down in Florida, as beneficiaries of the IRA as well, because everybody knows that makes sense because, you know, we avoid income tax altogether. Well, fast forward 20 some years, she's now over 95 years old, and she told her kids that to just take her out and shoot her if they ever needed to put her in a nursing home. So of course the kids will never put her in a nursing home, but they are spending a lot of money to be able to keep her in her homes, whether it be here or Florida, depending upon the time of year. But what ultimately I think is going to happen is there's not going to be as much left in those she's actually got two IRAs, in those IRAs as what she would have envisioned that she would want to have gone to the church. Okay. And then, as many of you know, when you're dealing with children, some of them have more than they need, and others can't wait for mom or dad to die because they want an inheritance. So they're very reluctant to change things up. And this particular client has dementia, so she doesn't really have the mental capacity at this point to change things up without the kids kind of coaxing her. So lesson learned there, and maybe some of the attorneys can tell me if I'm wrong, but I would now, the next time this situation comes up, and I think that it makes sense to leave to a charity a portion of the retirement monies, put a clause in the will that says, to the extent that the community foundation does not get at least X from my IRA upon my death, please carve out X or the difference from my remaining assets. Because what's going to happen is when these homes are sold, when this woman dies, when these homes are sold, these kids are going to make out like a bandit. But these two churches aren't going to get what she had intended for them to get. So I would think that you could have a kind of an open-ended clause. Karin, am I wrong?
You certainly could. You know, I think every attorney is sort of fidgeting in their seat over that because it always opens a lot of, we try to practice proactive estate planning, right, in our drafting. And sometimes those clauses just, we're just opening things up for litigation. Okay. Yeah, that's interesting. I thought as I was listening to, I thought maybe you were going to go more the direction of the cost of care not knowing what her other assets are and where she's pulling from. But certainly that raises, a really good point of why we're always, it's so hard to plan in a vacuum, and we always have to look at planning strategies based on what we're dealing with. And as you said, at the time she did it, it made perfect sense. But as life evolved and as her situation evolved, it was making less sense. So that was a really long-winded answer to your question. But sure, I mean, you certainly could put some sort of equalization type clause. I would, that would obviously be a last case resort technique.
We did actually just have an estate come in this year that was structured that way, where it was a specified amount in the will, but it was netted out against, the amount of a beneficiary designation on an IRA. So that was that did work out well. And yeah, I think about 2/3 of it came from the IRA, and the last third came from the estate. So.
Oh, good.
And one of the things you brought up that's so important is just to revisit the estate plan. I'll try to tell clients every 3 to 5 years they should consider relooking at it. And it's hard because the lawyers, I mean, they're not going to get back to the lawyers unless someone like you or me gets them back there. But so often the family situation, the money situation, things change. I've had so many clients over the last year redo their estate plan. It had nothing to do with COVID. It just had to do with their family getting older and changing fiduciaries and looking at the total asset values and changing the focus maybe from one thing to another just based on what was happening. So that's great that you brought that up.
Yeah, Grace, I always tell people the same thing, 3 to 5 years, or if health or wealth changes. And it could be the health and wealth of your client, but it could be of their beneficiaries as well. So those to me are good markers for reevaluating.
And I've had people whose wishes change based on all of those things that you mentioned too. It's almost like sometimes we have to give them permission that they can make changes and include charities, because sometimes the clients don't know what to do and the kids do influence them. You're right.
Mm-hmm.
Thank you, Madelyn, for sharing the scenario. And, it's, as you can see, the collaboration of advisors from different areas obviously is very helpful for the clients. And that's what we do here at the Community Foundation, work with the client donors, advisors. So thank you. And Karin, if you had a scenario that you wanted us, you wanted to share with us, that would be great.
Yeah, absolutely. I wanted just piggyback on Grace's charitable remainder trust example, and just remind people not to forget about the charitable lead trust. So it's not as attractive, I think, but I think it depends on the delivery and it depends on the situation. Because I have actually used a charitable lead trust in the past for clients that maybe want to stagger distributions to their kids. And so the charitable remainder trust, of course, pays an income amount for a term of years or lifetime or whatever, with the remainder being the beneficiary to the charity, where the lead trust is just the flip, where maybe we're paying the charity a stream of income and then the individual beneficiaries later on. And so I've had a couple of situations over the years where clients wanted to delay an inheritance to children for one reason or another. So I just wanted to bring up that point, is just not to forget about that. But I want to talk less about the technical situations, because as Madelyn and Grace can attest to, there's so many tax reasons and technical reasons of why we discuss charitable options, either low basis assets or retirement income and things like that. There's just a myriad of situations in that big old tax code that brings us to that conversation. There are some really good non-tax reasons, though, and I think that sometimes those are the conversations I have with clients, and particularly in this last year. So COVID estate planning has been a real interesting case study for me in my career, and for a lot of reasons, but I would say it was a real slow start. Last year about this time, we were all in our homes and worried, and we were worried about money, and we were worried about the future, and we were worried about so many things. You know, the year developed, and I was very, very busy. I think once I came back into my office last June, all of a sudden people started thinking more about things, end of life things. And unfortunately also, for whatever reason, partially due to COVID and partially due to other reasons, I've had a lot of clients pass away this year. And I've had two situations this year, which were sort of new situations for me, and how I brought charity up in those situations. And it involved a sudden death for two clients, and meeting with the family. And I hear often, you know, I would give this money back if I could have mom or dad back, or my spouse back. There's just this feeling about an inheritance sometimes, especially in unusual circumstances or sudden circumstances, or not so sudden, where we feel maybe a little bit of guilt and remorse. And I've seen that this year. And in both of those situations, I've brought up the topic of honoring that loved one through charitable giving. And it really changed the tone of the planning. And we're still in the process, so we haven't wrapped things up. It's a slow process, as we all know, but just having those conversations and just saying, you know, hey, you know, maybe we can do something here, either a scholarship or a fund where we could honor that person. And I think that it makes the grieving process maybe a touch easier for those folks. So that is something that has come up on the non-tax end for me this year, that we've looked into, and surprisingly it has resonated with more than one client. So just wanted to throw that out there as a different approach.
So thank you, because, you know, we do talk about, you know, not only to your clients, but, you know, talking about the younger generation, talking to the younger generations about charitable giving and involving them in this process overall in the planning, you know, from all aspects of planning work. But it's great that, you know, Karin, you brought up after the fact, after, you know, they received the inheritance, and honoring their, you know, deceased relatives, the parents or whatever. And there's so many ways to do so. So that's really important, and non-tax reasons like you mentioned. So thank you all for the different scenarios. I'm sure many of you, you know, it resonated with you here. Thank you. And the last question that I have deals with the evolution of your approach with your clients, talking about charitable giving with your many years of experience in different scenarios. So the question that I want to ask is, how has your approach with your clients changed over the years, whether it's due to your involvement with local nonprofits in the community, a community foundation, as board members, as a fund holder, due to the changes in the tax laws, you know, some of you talked about, or due to the COVID, you know, 19 health crisis this past year. So I think I'll ask Karin first on this one.
Sure. Yeah, I think my approach has changed. A couple of things I want to raise, and just to circle back with something that Madelyn had said earlier, is that, you know, with newer, maybe younger advisors or professionals that are talking about charity, sometimes they don't have the confidence yet to say, geez, you should look at this, or you should look at this, because they don't yet know what the options are. Well, the truth is, maybe none of us really know what all the options are, but one thing that I do know is that the folks at the Community Foundation know a lot of things. And so I find that when, with my approach, especially if I have someone that has the charitable ideas, but we haven't really nailed down the perfect way to achieve them all. I am certainly open to the suggestions that the foundation provides. And sometimes there are things that we as lawyers and accountants and financial advisors, we don't think of. There are ins and outs that you do, and sometimes just more from a more efficient and practical standpoint. Sometimes those are better solutions. I always like to involve the foundation in those conversations, and you guys are great to oblige and have those conversations with clients. But I think just to know that there are people out there that can assist with tying up those planning suggestions and opportunities. So you don't need to know everything. You just need to know that there are people that can help. And the foundation certainly does that. And another point also that Madelyn had brought up earlier is just from a compliance standpoint. A lot of clients say, I want to create a private foundation, or I want to, have a scholarship fund, or I want to do this. And the tax laws for nonprofits and compliance has changed significantly, both federal and state, over the last several years. And I don't know that clients always know how thick they are getting into the weeds with compliance. And so that's another situation where I always, like to involve the foundation as a possible solution, purely from a compliance standpoint. So I guess my, my approach has just changed in bringing up the conversation. People aren't going to give to charity if they're not charitably minded. So we've got to have that as the foundation. And even if in that original conversation, they look at you like you're a little crazy, sometimes it's just planting the seed. And sometimes I find that planting the seed comes back to really bloom into something great, even if it's a few years later. So knowledge is power, and I try to give my clients as many opportunities to come to those solutions and conclusions themselves, be it at the time we meet or maybe 5 or 10 years later.
Thank you for that, because that just speaks to the fact why my role at the Community Foundation and what Tom did before I joined, the outreach that we do with professional advisors, just to let them know that we are here as a resource if any questions or scenarios come up with their clients, and where you see a possibility of how charitable giving can help that client. So thank you for that. That's very important. And Madelyn, if you could let us know how your approach has changed over the years.
Sure. Well, and I've been very vocal about this, but once I was on the board of the Community Foundation and learned what it was all about, I mean, that was priceless in and of itself, because once you understand and you realize what great stewards they are of people's money, it makes it really easy to say, call them. They'll help you out, because again, as CPAs or as any professional advisor, we have to be really careful as to who we're recommending, because it comes back to bite you sometimes. But I will tell you that as far as how I've changed over the years, you kind of learn who's not going to let you down. And the Community Foundation, I know, is a good choice, and it's not going to let me down. But as the tax laws change, our approaches change. So again, that's that game that makes it so fun to be a CPA is because we constantly have new things to approach our clients about, as to new ways for them to potentially give and save money while giving. Because for some people, they're very tax motivated, like it or not, they are. And it's recognizing, who those people are. The other thing that's changed for me as I've gotten older as well is recognizing how important it is to get people in to see their attorneys sooner rather than later, while they still have that mental capacity to be able to think through and figure out what it is that they want. Not to say that it's not going to be revised every 3 to 5 years, but at least get them thinking about it and talking it over with their spouse while they're young. And the other thing is, I'm born and raised in Syracuse, so I love it when I see my clients giving so much back to the Central New York, community, and helping those people that, aren't as fortunate. So the ability to get people while they're still living here, before they move to Florida, or before they go move to be with, after their husband dies and they go to move closer to their daughters, outside of Central New York, what I've learned is the sooner we can get people to the table with their attorneys, the better off we are. So young, while they're still here, and then just play the game as to what's in the best interest of that particular client.
Thank you. I appreciate that. And Grace, if you could share, how your approach has changed over the years, that would be great.
Sure, thank you. After more than 40 years of dealing with people and their finances, I have really found that most people do give to charities. They don't think about it when they're looking at tax and financial planning and estate planning. Yeah, they'll put the numbers on their itemized deduction schedule or take their QCDs from their IRAs. But to really think about the role that charities have played in their life, I think we as professionals have a responsibility to really help people meet their goals, whether they know what they are or not. Sometimes from our relationships that go on for years and years, people get more comfortable with us, and they talk about things that are not just the black and white, the numbers, the things you put on paper, but all those other qualities and parts of their life that are so important to them in other ways. I used to ask people, do you have charitable intentions? So when you say what's changed, that used to be one of my standard questions. I never ask that question anymore because that's a yes or no. And I say, how does charitable giving fit into your overall financial plan? And people sit back and they really think about it. And couples will look at each other and they kind of nod in and start talking about what's important. And when they answer that question, I then ask them one more. Are you spending your money in a way that reflects your overall goals and values? Now, I don't challenge them. It's their money. They can do what they want, but they appreciate that perspective, because it really gives them an opportunity to think about what's important to them and to make sure they're spending their money in a way that exemplifies those values. Planning can help them learn new ways of giving, just like I said, not just writing checks. Usually those ideas take some time to resonate. So if I do a financial plan and I have an implementation checklist at the end that tells people, here's the things you should consider. Charitable giving in some way, shape, or form usually ends up on that schedule. But sometimes it takes them till the next year. As Karin said, you plant a seed. And they come back and you say, well, here's where we left off. Let's talk about the things that we left open-ended. Now, if they close the door and say, let's take that off the list, that's fine. But they rarely say that about charitable giving. They'll want to explore it. And then all of a sudden, they will think about a Roth conversion, because someone like Madelyn will come along and say, well, there's some things you can do. And then they'll say, well, you had mentioned some charitable things. Does that make sense that we combine these strategies and work together? So it comes from them and not from me, which makes them really feel into it and believe it. But it doesn't happen overnight. So I guess my piece of advice to professionals that might be grappling with this, Don't give up on clients if they just say, you know, not today, because it doesn't mean they're not going to do it or they're not interested. I don't apologize for asking those probing direct questions now. And like I mentioned earlier, some people are looking for permission to include charities. Maybe it's if their kid's predeceased. Maybe it's, you know, the famous question, give your kids enough so that they have enough to do anything, but not enough so they can do nothing. So how much go to the kids? What should go to charity? How does that reflect your values? I had a client once that came to me that was giving a substantial amount in their will to a charity. Well, instead of that, I said, you can get an income tax benefit now if you create a charitable remainder trust, which they did. And every year they add to the trust. So the charities will get more, their retirement income is more. And when I asked them if they're okay with how much is going to their kids, it's not an issue for them. You know, first of all, it's not a 1-for-1, because a lot of the charitable giving at their death will come back to them during their lifetime in terms of tax benefits and additional income. But they also feel very good from a philanthropic standpoint that their kids are fine. They've raised them, you know, they've got their lives, and now it's time for the family to continue their philanthropic mission. No one knows how many years we're going to be left on this earth, but for people that have been giving year after year, that legacy doesn't stop when they pass on, and they still want to benefit our local community. As Madelyn said, I was also born and raised here, and I love when people can take that mindset and really think about how the community's been important to them. I also second what Karin said about the community foundation meetings. I have brought clients in to meet with Tom. I've taken part in Jan's legacy seminars. There is so much knowledge and so much information, and the way they deliver the message just totally different than the words that I would use and the process that I would use. And it's a wonderful thing. So I encourage anyone who's considering doing more of this to certainly start with the foundation. It's a great place to find out and educate. We've got a brand new website. It's lovely. So you can educate yourself on what's available and then talk to the individuals there to make these things resonate with your clients.
I'm still a huge fan of that 5 for CNY slogan. I mean, even myself as a, 5% of my retirement, to the community foundation, because it's just so easy and it just resonates. So that whoever came up with that was brilliant.
Thank you for that. All of you hit some such good points, asking open-ended questions, planting a seed, and the fact that it takes time. I've been at the Community Foundation for 2.5 years now, and coming from a corporate background, just the first year asking Tom and Peter and Jan saying, and they would say it takes a long time, so just being patient, being there for them with, listening to their needs and questions, that's the key. And, most of you, like Madelyn and Ghezzi said, you are here from Central New York, so you're born here, raised here, and worked here, and lived here, and you want to get back. So Tom has put up our 5 per CNY campaign, giving 5%, leaving it in your community. I think a lot of you are aware of our campaign that we did started in 2012. So thank you. It is 1:02. We have some time if any of you have questions for the panelists. Tom and Jan and Peter are here as well. So free for all. If not, I'm going to put Tom in the spotlight here. If you wanted to, based on your experience with the foundation, working with the advisors in our community, if you wanted to, share some of your insight.
Yeah, so I put a few things in the chat along as everybody was speaking, especially to that last question. It is something that surprised me, that a lot of advisors just don't ask that question. Just simply asking, are there, organizations that you care about? Are there organizations that you give to now? And Madelyn made the point, she has the purview, the vision to be able to see the details, in their tax returns, so she knows the answer to that question. But I think even in the case where you see the numbers, there's a lot of value in asking that question of just saying, are there organizations that you care about? Tell me about that. By understanding what's important to your clients, what their connections are in Central New York, not only does it, help strengthen, the relationship that you have as an advisor, but also, just helps fill in that holistic planning picture. And then just to echo the comment I put in the chat, we love to get questions from advisors. We welcome that at any time. And, we get them, from local advisors, we get them from advisors that are reaching out to us about something that's New York State related, from other places, we get them, a lot. And, I would say a good number of those, don't end up being something that the Community Foundation can actually, do or help with, other than, to talk through it with the advisor and point them maybe in the right direction as far as, what is, a path that they could take to meet that client's needs. But many times it opens, the advisors, to other solutions that maybe that we can help with. And, we're glad to, or that other charities just here locally might be able to help with. So it's not even just about us, we want to make gifts happen that otherwise wouldn't for our community. Our mission is to help grow, resources for local nonprofits. And, that's not just about, creating funds at the Community Foundation. So it's a we're all in this together approach. And as you can tell, we definitely picked, 3 of our, most best friends forever financial or professional advisors to be on this panel. So I really appreciate the comments that all of you made and the time that you've spent preparing for today and sharing, your perspective. So thank you.
Yeah, thank you so much for the time and your sharing your knowledge, Karin, Madelyn, and Grace. And thank you for those who've joined us today. Hope you learned more or something new from these panelists. And one thing that Madelyn had mentioned that, like some younger advisors or newer advisors may not be aware of various ways of charitable planning. So what Tom and I do with our professional advisor outreach is that, we can come and present on any charitable planning topics to your firm, to, any new members in your organization. So please keep that in mind. Right now, it's pretty easy, the virtual like this with Zoom presentation, and hopefully in the future in person too. So that's something that we do provide for any firms and any topics. And please feel free to reach out to me. We have lifetime giving, legacy planning that Jan does. So feel free to reach out to any of us at the Community Foundation. Our website is cnycf.org. Thank you so much. We are close to the 1:15 mark, so I think we can end the session now if no one has questions. Thank you all.
Thank you.
Bye-bye, everybody.
Bye.
Thanks, everyone.